Well, hi everyone, Sean Humphreys here. Welcome to All Things Retirement. Well, in this video, we're going to talk about why you should have bonds in your portfolio. And I know, ho-hum, bonds are paying low interest rates and they can sometimes fluctuate in value, but they play a really important role, particularly as you get closer to retirement and then move through your retirement years. So we're going to cover off the role that bonds play in portfolio design. It's absolutely critical. Now, if you're new to our channel, make sure that you hit the subscribe button if you don't want to miss future content. We're posting content on all things retirement, the accumulation phase, the transition phase into retirement, and of course, being retired. So if you don't want to miss that future content, subscribe to the channel. So let's take a look at why you consider bonds for your portfolio. So the role of fixed income investments is a bit of a challenge right now because interest rates are so low and they've been low for a long time. So the initial default position would be, aren't they just going to be a drag on performance, right? So that's a valid concern. So let's continue to unpack this topic a little bit. So fixed income reluctance can be a combination of the low interest rates and that many people know that there's a bit of a relationship between prevailing interest rates and your bond rate and that the bonds can fluctuate in value. Now that's the secret sauce around bonds. It's one of the reasons that we need to have them as part of our portfolio mix, that fluctuation. But initially it can be perceived as a negative thing in terms of the portfolio. So let's do a little primer on bonds. So this might be old hat for most of you. Let's go through it though. So if I have a bond, and the bonds we're talking about are tradable bonds. So they could be government debt, corporate debentures, so bonds that have a secondary market. So you buy the bond, and after you buy it, you can actually sell it before the maturity date. But at a very basic level, we could have a bond that has a maturity date of 2026, $10,000 bond, 3% interest rates. We know that we're going to get $300 per year from that bond. And that in the year 2026, we get our $10,000 back. So at that level, the bond acts much like a term deposit or a guaranteed investment certificate. But the other component to bonds is that they fluctuate in value. So you can see this bond, again, we're getting 3%. But if interest rates go down to 2%, my bond looks pretty darn good. So my bond will trade at a premium because people can't get 3% anymore. And if I sold the bond, I would demand a premium of $1,000 in my example here, and people would be prepared to pay me a premium. Now the reverse is true. If interest rates go from 3% to 4%, now my bond trades at a discount. Nobody wants my bond paying 3 when they can get 4% interest rates on their bonds. So in that situation, it trades at a discount. So people will buy the bond at a discount because if they can get it for 9 with a maturity date amount of 10, they've got a built-in profit of 1,000 plus the 3% would be equivalent in their minds to getting the 4%. So this fluctuation is very important as it relates to portfolio design. Now, what influences the fluctuation? Well, it can be the term of the bonds. So the longer the term, the more the fluctuation will be potentially. The interest rate, so the greater the difference between your bond rate and prevailing interest rates in the overall environment can create excessive and increased volatility or fluctuation. The credit quality, obviously, government bonds will fluctuate typically less than corporate debt. And the economic climate can really influence the expectations about where interest rates are going to go. So bonds can fluctuate not just based on, what interest rates do, but what interest rates could do. So the bond market will look into the future and begin to, think about where rates are going to go, and you'll see traders in the bond market begin to trade positions based on where they think it might go. So these are all factors that will influence the price of your bond. Now, that's just part of the story. Bonds can reduce overall portfolio risk. So we're going to talk about that. So yes, bonds over time, if you just hold them, most of your return will come from the cash flow of the bonds, the interest rate. But the fluctuation plays a very important role in terms of portfolio risk reduction. So why is thinking about market risk topical? Actually, it doesn't matter when I do these presentations. There's almost always something happening in the background that creates uncertainty and the potential for volatility. So we always need to be thinking about risk with our portfolios. And it's really important to think about risk before risky events happen, so that we're already anticipating what our response is going to be based on the kind of fluctuation that could take place in our portfolio based on its design. So it's really important to kind of step out of your current environment, Think about what your response would be to risk or volatility, and then construct a portfolio that is consistent with your risk temperament. Now, there's a number of factors that can influence the economy and bond markets. It could be, again, interest rates or valuations in the markets high or low. What about government support, fiscal support, central bank support, or monetary support, and the current economic growth profile? Those are all things that can impact the markets. But here's the reality. Even the best economists cannot successfully predict exactly what's going to go on. We live in a very complicated world. So if you have someone telling you that they can read the economic tea leaves and indicate to you what's going to happen in the future, be very suspicious of that. Now, portfolio managers and advisors can have convictions about things, but it's not appropriate for them to build portfolios around those short-term convictions. There are first principles about how you design portfolios that over the longer term will give you a high probability of success. I'll give you an example here that's really important. So let's say I've got $10,000 invested. This is the S&P 500 back in 1980, 500 largest stocks in the U.S. If I put the $10,000 into the market and let it grow for 40 years, my $10,000 grew to $708,143. And I've reinvested all dividends. If I miss the top 10 days, out of that 40 years in the market, my growth was 341,484. Huge difference between those two numbers. And if I missed the best 30 days out of 40 years, I went from 708,143 to 135,226. So what this illustrates is that there are very few days in the market, it's very concentrated, that drives most of the return or performance on stock market portfolios. Hence, it's almost impossible to time the markets consistently. You might be able to get it right once or twice, maybe, but you're not going to get it right consistently. So when you're in stocks or building a growth portfolio, you need to be in the market. Doesn't mean you don't fine-tune a little bit, doesn't mean you don't take profits or readjust the portfolio. In fact, that's important, particularly for retirees. But you don't want to make major tactical changes. So if that's the case, how do we deal with risk? How do we deal with volatility in our portfolios? Well, the way that we deal with the market risk is by blending securities. So blending stocks and bonds, or it could be blending stocks, bonds, real estate, and cash. But by blending those assets, you begin to have what's called cross-correlation. So the red is the stock market, it's going up and down, and the black is the bond market, which is more stable and may even rally during periods of downward trends in the stock market. So what you begin to do is feather into your portfolio real estate, cash, or bonds to reduce overall portfolio risk so that you do not panic or capitulate out of the market. So you need to assess the level of fluctuation or risk you can live with in advance of that fluctuation happening in your portfolio. So when you add bonds to your portfolio as part of the overall mix, think of it as one unified portfolio. Don't look at the bonds and go, oh my goodness, the bond yields are low. Oh my goodness, the bonds currently are down a little bit. View them as overall one portfolio that will have a certain characteristic of return and a certain risk profile. And if I go back to this chart here, sometimes bonds will do very well and they'll counterbalance some of the downside volatility or losses that could happen on the market in stocks. So by looking at the portfolio as one unified portfolio, you'll begin to appreciate the dynamic interaction and helpful interaction that bonds can play in your portfolio. Now this chart is a great example of what I'm getting at. So this is from Vanguard Investments, and they looked at the best, worst, and average returns from 1926 to 2019 on various portfolio mixes. Now, I'll show you a portfolio that's made up of 70% bonds, 30% stocks, and you can see that portfolio averaged 7.2% compounded returns over that time period. The worst one-year return was minus 14.2, and the best one-year return was 28.4%. If I go to a 100% stock portfolio, you can see that the return went from 7.2 to an average of 10.3 compounded. Now, the range of returns was minus 43% to plus 54%. And what explains the ranges of return is as you feather in more bonds, typically you see less dynamic fluctuation in the portfolio. But it also reduces the overall performance on your account. Now, this is why this information is so important. You want to re-engineer or reverse engineer this discussion. What you should be doing initially before you even get to this point is to do a bit of a financial analysis, have your advisor do a retirement income plan, and figure out what you need to get as a return to achieve your financial goals and objectives. Once you know that return, then you know what kind of portfolio design you should be taking a look at to be driving in that direction. Part two of that is, let's say that you need a return of 9.2, but you see that the potential volatility here is minus 30. Now, there may not be a high probability of that happening, but it could be that kind of range. So in that situation, you may go, that's too much volatility. I want to add more bonds. Then you use a lower return, redo the financial forecast to see what that has as an impact on your planning. And it may mean you have to back up your retirement date a little bit. It may mean you have to add more money to your portfolio. So there's various implications, but then you're not making your investment decisions in a vacuum, and you're sliding bonds into your portfolio appropriately. So when you look at the overall mix, this mix of bonds and stocks, again, think of it as one dynamic portfolio, not a portfolio of bonds here and a portfolio of stocks there, because you will see this cross correlation going on over time. So fixed income, in a nutshell, is really a way of buffeting against short-term volatility. A negative correlation of stocks and bonds is helpful. Bonds act as a shock absorber to reduce the overall risk and volatility on the portfolio. Well, it's my hope that you found this discussion helpful. And again, if you look at the show notes to this video, there's a link back to our website. So if you want to find out how you can get your own customized retirement income plan, we've got information there, as well as some helpful educational resources on retirement income planning as well. And again, if you haven't subscribed to our channel, make sure you do that right now. And if you like the video, click like. You take care. All the best in your retirement income planning. Bye-bye.